Welcome to Chapter 8 in your Cornerstones textbook. This chapter focuses on liabilities, which are things that are owed by a company. Remember that liabilities show up on the balance sheet, and in Chapter 8 we're going to focus on current liabilities, specifically liabilities that are owed within 1 year and are expected to be paid with current assets like cash or marketable securities or the sale of inventory or something like that. Now, current liabilities may include things like accounts payable, various accrued liabilities, things like wages that are payable at the end of a period but have not yet actually been paid, taxes that are payable. Current liabilities may also include notes payable, the current portion of long-term debt, sales taxes, withholding and payroll taxes, and unearned revenues. Let's first look at accounts payable. Accounts payable arise when a business purchases goods or services on credit. This is sort of the flip side of an accounts receivable. So when a business buys something from another business and buys it on credit, it causes an accounts payable journal for the buyer and an accounts receivable entry for the seller. Normally, an accounts payable is not a formal contract, it's an invoice or a bill. So upon purchase, the appropriate journal entry would be a debit to some expense account, or if this is the purchase of inventory, and remember this from previous chapters, it would be a debit to an asset account, and then there would be a credit to accounts payable. When the accounts payable is actually paid, there's a debit to accounts payable and a credit to cash, since the company would actually be paying for it. On pages 388 and 389, your book goes through an example. It focuses on Game Time Sporting Goods that buys and receives running shoes on May 15, 2011 on credit. On June 15, 2011, it paid the supplier $2,000 for those shoes. So let's look at the entries we would actually make. On May 15th, when Game Time actually purchases the shoes, there would be a debit to inventory, since we're going to assume that Game Time Shoes is going to resell these for $2,000. And there would be a credit to accounts payable. Remember, accounts payable is a liability account, so it would be a credit of $2,000. And then when it actually pays the bill a month later on June 15th, it's going to debit accounts payable, which will now clear that account. It now no longer owes $2,000. And since it's actually paying a bill, it would be a credit to cash of $2,000. Let's see how that looks. Now, another kind of current liability are accrued liabilities. These are the completed portion of activities that are in process at the end of a period. They're recorded with adjusting entries, and you've actually looked at most of these before, so this section is a review from earlier chapters. At the end of a period, whatever accrued liabilities that a company has, they would record a debit to an expense account. In other words, they have to match that expense to the period in which the revenue that's associated with it actually occurred. And then they would credit a payables account. So for instance, if it was wages that had actually occurred during the accounting period but had not actually been paid yet, there would be a debit to a wages expense account and a credit to a wages payable account. When the liability is actually paid, for instance, those wages, there would be a debit to the payable account to clear the liability and a credit to cash, considering cash would have actually been used to pay for it. Take a moment and read this scenario for Green's Landscaping. So we have Green's Landscaping, which runs on a 2-week pay period. There are 10 work days in every 2-week pay period. Now what happens is on December 31st, it's actually a Tuesday, and December 31st is a time of year that Green's Landscaping needs to close its books. So on December 31st, it is week 2 of a 2-week pay period, but it is Tuesday. So there are 7 days. By the end of that Tuesday, there were 7 days that have been worked. What would the adjusting entry look like? Well, on December 31st, there would be 7 days of work at $1,000 a day that had actually been worked, and they are owed to the employees, except they won't be paid for another 3 days. How do we make that adjusting entry? Well, on December 31st, I would say it's proper to show that the wage expense has occurred to the tune of $7,000. And now I have a short-term liability, a current liability on my books, which I'll call wages payable, of $7,000. Now I've just a debit to an expense account and a credit to a payable account. Now, January 3rd is the Friday of that pay period, and those workers would actually be paid. So, on that day, we would be able to clear wages payable of the $7,000, but remember, on that Friday, another 3 days would have been worked. So another $3,000 of wages expense would have been incurred. So that paycheck would have caused a credit to cash of $10,000. Let's look at that. Notice, we made a debit to an expense account, a credit to a payable account in order to close out the period. But once the payroll actually occurred, we clear the payable, we have to add 3 more days of an expense, and then all together we write checks for $10,000, which is a credit to cash for that amount. Another form of current liabilities are notes payable. These occur when a business borrows money or purchases goods or services requiring a more formal contract. Now, borrowing money may be from a bank. If it's a notes payable, we assume it's usually short term, so it would be a bank loan for under a year. Or it could be that a company needed to take more than 30 or 60 days to pay back one of its suppliers, in which case the accounts payable turns into a notes payable, and interest is probably going to be due. So a notes payable is different from accounts payable in that normally it is longer than the usual 30 to 60 day pay period of an accounts payable, and notes payable generally accrue interest. So when the note is received, there would be a debit to cash and a credit to notes payable if it's a note from a bank. At the end of any period, you'd have to record any interest accrued but not paid. Sometimes interest is not due on a note payable until the note itself is due. So if there is a period ending, an accounting period ending sometime during the life of that note, interest accrued would need to be recorded. That would be a debit to interest expense, and as usual, we have a debit to an expense account and a credit to a payable account, which in this case would be interest payable. When the note is paid off at the end of its maturity, it would be a debit to notes payable, a debit to interest expense if there was additional interest between the last time it was accrued and the payment of the note, and then a debit to any interest payable that had occurred because of the accrual entry or entries. And then there would be a credit to cash for the full amount being paid, which would be principal plus interest. So let's look at an example. This is your Cornerstone 8-1 on pages 390 and 391. We have a company, Fitch Auto Parts, and they've actually borrowed $100,000 from a bank on October 1st, 2011, and it's due a year later, October 1st, 2012. So first, let's look at the required journal entry for the issuance of the note. It was issued on October 1st, 2011. What would have happened? Well, Fitch Auto Parts on that day received $100,000 in cash, so that would be a debit to cash of $100,000. And it now owes that money to the bank in a year from now, so it would be a notes payable credit of $100,000 because the notes payable is a liability account. Now, 3 months later, Fitch Auto Parts hits the end of its accounting period. The note is not due yet because it's not due until October 1st, 2012, so it just needs to accrue the interest. So there would be a debit to an expense account. Interest expense would get a debit of a portion of a year's worth of interest. What portion? Well, it would be 3%, 3 months of 10%. So how we would figure that out is $100,000 in principal times the 10% interest rate times however many months are actually in this period, which is 3 months, October, November, December, divided by 12. That comes to $2,500 in interest expense. And remember, we always have, when we're accruing something at the end of the year, we've got a liability account that we're going to credit, and that would be $2,500. Now, what do we do on October 1st, 2012 when this is actually due? Well, we no longer have the liability of the notes payable, so I can clear that liability. I would make a debit entry for the full $100,000. There would also have been, from January 1st, 2012, all the way through October 1st, 2012, 9 months of interest. Those 9 months of interest would have been figured out at $100,000 of principal times 10% interest times 9 divided by 12. That actually comes out to $7,500 worth of interest expense that would have occurred during the year 2012. And then remember, we did have an interest payable that had been hanging around since December 31st, 2011, and that was $2,500. So let's look at this all nice, neat, and clean. I would have cleared my notes payable by making a debit entry to notes payable for the full $100,000, but then I have to pay interest. Remember, it was 10% interest, 10% annual interest. Well, 10% of $100,000 is $10,000, so I would have to expect that the amount of interest expense for the months in 2012 plus the amount of interest expense for the months in 2011 would have to equal $10,000, which they do. This is 9 months of interest, and this is 3 months of interest, altogether 12 months of interest. So when the company pays back, it pays back a full $100,000 plus $10,000 in interest for a $110,000 credit to cash. Now, let's look at one last example of a note payable that results not from a company borrowing from a bank, but from a company going to one of its suppliers and asking for an extension on paying an accounts payable. So let's look at the company Gibson Shipping. They purchased $25,000 of packing materials from Ironman Enterprises. It was on credit or on account. It was due on May 15th, 2011. So first, let's just figure out what entry would Gibson have made to record the purchase of the packing materials. Well, the date is going to be the date of purchase, so March 8th. And on March 8th, the company would have, so there would have been a debit entry to supplies, because these are packing materials, and that would be a debit of the $25,000, and they did this on account. They purchased on account, so there would have been an accounts payable, a liability, which would be a credit of $25,000. Now your book goes on to say that Gibson arrives at May 15th, and it turns out they're not able to make the $25,000 payment. So they go to Ironman, their supplier, and they ask for a payment extension. Now sometimes the company will offer a payment extension and not ask for anything extra in return, but usually a payment extension comes with a little extra, and that's going to be, in this case, a note with 7% interest that begins on May 15th, 2011 and is due on November 15th, 2011. So a 6-month note. How would Gibson, the company that was unable to pay $25,000 on May 15th, how would they record this note? Well, first of all, we want to give it the date May 15th because this is when things changed. Remember, they couldn't pay their accounts payable as of May 15th. So by entering into a note payable, they are essentially clearing off that accounts payable from their books. And they're replacing it with another liability. So in this case, we debit one liability account and we credit another liability account. so that we now have a $25,000 note payable on the books, and we've eliminated $25,000 of accounts payable. Now let's say that we arrive at November 15th, 2011, and Gibson is able to pay the full $25,000 plus the 7% interest. Now remember, interest is always quoted as an annual amount, so it's 7% interest, but on a 6-month note. So how much interest would they have paid? Well, it would have been $25,000 of principal times 7% annual interest, but what portion of the year was it? Well, it was 6 divided by 12. That comes to $875. So on November 15th, there would have been the clearing of the notes payable by debiting notes payable for $25,000. There would have been the recording of 6 months of interest expense to the tune of $875, and there would have been a credit to cash of the full $25,875. Now, one other current liability that is common to see is the current portion of long-term debt. Remember, sometimes companies enter into long-term debt. We'll cover more of that in Chapter 9, but some portion of it may be due in any given 1-year period. So at the end of every year, a company is going to need to look at what is due in the coming year on any of its long-term debts, and it will need to reclassify them. It doesn't always require a journal entry, it's just a reclassification on the balance sheet, especially if the long-term debt is paid off by entering into new long-term debt. This concludes this video.